Have you ever wondered if you can use your own IRA to invest in real estate? Simple question, simple answer is yes. And there are restrictions, as always, with everything. For this video, we're going to break it all down. We're going to show you why you would want to do that, how you can structure your IRA to invest in real estate, and then, of course, some of the features and pitfalls to avoid along the way. Then we're going to give you an example of how this is all going to play out. And as always, you're going to learn a lot. So let's kick off this rodeo right now. Hi, folks. I'm Kevin Fagan. I'm the Mortgage Patriot here in Central Texas, nestled in the hill country above San Antonio, serving proud Texans and great patriots all across this country with real estate financing and or acquisition needs. So as you know, I've done a lot of videos prior to this on real estate investment, because that's usually the primary means of acquiring wealth in this country is just owning property, be it your primary home and or rental homes. So I've done a couple of videos on how to establish as a primary home, first of all, building a portfolio of rentals through either VA purchases, using VA loans, or using FHA loans as your starter loans, or I've done a video or two on lines of credit for investment properties. Here we're going to talk today about the important topic of investing using your IRA or your qualified monies, your retirement funds, to invest in real estate. So let's get after this right now. So as I begin today's topic, especially if you're new to the program, hit the like and subscribe, please. That helps you and it helps me build my library of YouTube videos, for ultimately for your benefit. I really want to be a quality, trusted source that you can rely on for good information. And so again, like and subscribe, make a comment, and I answer every single comment, I promise you. And as a lot of you have done, reach out to me at 210-317-6514. Text me first if you would, see if I'm available, and I can tell you right then. And we can chat a little bit, and I can answer your question immediately, or we can set up a time to schedule a 5 or 10 or 15-minute phone call. So having said all that, let's get into this topic right now. Now that you know you can purchase investment real estate in your IRA or your 401k, your qualified monies, why would you want to do that? Well, there's two main reasons. And the first reason is it's one of your largest assets, meaning it's probably got a lot of money in it. Why? Because you likely, if you've been working at a company for any number of years and they have a 401k that you've been contributing to, that starts to add up pretty quickly. If you've been there 5, 10, 15 years, it's not unusual at this point. If you check your 401k statements quarterly, you'll see $50,000, $125,000, $200,000 or more. And you don't have to be a giant wage earner to do this. If you're making even $75,000, you're making your maxed out contributions to your 401k, and you're 5 years down the road, you might have $50,000 in it already. So you've got a nice egg to start with there for potential purchases. Second reason why is because you can utilize the leverage of real estate. Just like outside of an IRA, just a normal purchase of an investment home, you're utilizing usually a big loan to do that. So you're leveraging the power of your note that you're getting versus how much money you have. So an IRA or qualified monies to buy an investment property is no different. You can multiply how much you have in that account by using the leverage that's going to be extended to you by a financing source. So as a quick example, in other words, let's say you have $50,000 in your 401k right now. And you could say, well, I can't buy real estate for $50,000. Well, maybe you can, maybe you can't. Likely you cannot. But that's why you can use a loan inside of your IRA. We're going to get into that. And leverage that $50,000 to acquire real estate. So in other words, you're not buying real estate dollar for dollar inside of your IRA. You're using the leverage from a financing to acquire real estate. So pretty cool, right? Now you know that you can invest in real estate through your IRA or a qualified account. And now you know that you can get a loan, a mortgage loan inside of your IRA. You probably didn't know that one. So in other words, you don't have to buy dollar for dollar once again. You don't have to have $200,000 in your account to buy a $200,000 asset, real estate asset in your IRA. So, okay, how do we do this now? Number one step is to start a self-directed IRA. A self-directed IRA is exactly what it sounds like. And instead of a custodial, because right now, you have these giant custodial accounts like Fidelity or Transamerica that run most of these retirement accounts through corporations. A self-directed IRA account allows you to do the directing yourself. You can decide what you want to invest in. It doesn't just have to be real estate. Of course, we're talking about real estate now, but it could be cryptocurrency, for gosh sake. It could be giving loans out to other people, believe it or not. You can give loans out of your self-directed IRA. You can do a number of things. You can even start up capital for your own, for a business of yours. But as it relates to real estate, you get to direct what you want, where do you want those monies to flow. So you can direct them towards the purchase of investment property. So I can help advise you on all this. The monies would, on your side, would flow from either an existing 401k or an existing IRA, either be a Roth IRA or just a normal IRA. There's 3 or 4 or 5 different types of IRAs these days, it seems like. So all those qualify. All those monies would flow into a self-directed IRA account at a firm that specializes in self-directed funds. So with that in mind, there's going to be some guidelines and best practices that you're going to want to do. And let's get into those right now. Now, remember, folks, I'm trying to give you a very general overview here. If I really wanted to get into this with you, it'd be at least an hour-long discussion going into the nuances and details of how to invest through your IRA. But we're trying to keep it to a reasonable amount of time. So, and I do want to give you an example at the end. So stick around for the example because it's going to make a lot of sense as I go through actual numbers. But let's talk about some, guidelines and best practices. Number one is, when your money's flowing into a self-directed, specialized self-directed IRA account, okay, you're going to want to establish a LLC. Why do you want to establish an LLC? Because it makes investing in a real estate transaction just that much easier. And it does provide some layer of protection. The firms that I'm going to connect you with, the ones that work, solely with self-directed accounts, are going to help you facilitate this. Now, doesn't cost a whole lot more, costs just pretty much the same as getting an LLC. Otherwise, as you would invest in a real estate transaction outside of an IRA, you want to use an LLC typically for that. So this is going to be the same kind of procedure for the same reasons. Along with the establishment of an LLC account, inside of that self-directed account, you're going to be allowed to have a bank account. So you have a bank account in the LLC that's owned by your IRA, your self-directed IRA. And all this allows, again, functionality, much more ease of use, allows you to write checks, in other words, to contractors if you need to fix something on your home, or you need to write checks for anything that has to do with the management of that property. Now you can do very simply with a bank account in an LLC in your self-directed IRA. Now you have your self-directed IRA account established. You have your LLC established with the bank account. You're ready to go, basically. What can you do? What can you not do? Well, there are what they call prohibited transactions. And the main thing you need to know, the only thing you really need to know, is that the number one rule is any investment you make in that qualified account, in your self-directed IRA, can only be for the exclusive benefit of that account. It can't be for your personal benefit. So, for example, you can't buy a rental home inside of your IRA and then rent it to yourself to live in. That's prohibited. You can't buy a home in your IRA and then rent it out to a son or daughter or even some relative. That's there's some personal gain going on there, or there's some related personal gain. That would be prohibited. So there are transactions that are prohibited. I can give you the laundry list of prohibited actions, but just basically know you really want an arm's length transaction when you're buying a home through your IRA. In other words, you're just going to rent it out to a individual that is not related to you. And by the way, you cannot buy a primary home inside of this account. This is only resigned to investment properties. Lastly, before I get into an example, let's talk about the leverage involved in an IRA account if you want to use it. What does that look like? How does it work? Let's say you have $75,000 in your self-directed IRA at this point. You've transferred it, everything. You've set up your LLC, you've got your bank account, you're ready to go. And now you want to target a property. But you can't buy one for $75,000, of course, but you have access to a loan. And what type of loan would that be? Well, it'd be a traditional mortgage loan, but it would be what they call a non-recourse loan, meaning you're not going to be personally responsible for it. That sounds great, right? Well, it has to be that way because remember, you don't own this. Your LLC owns it, and it's considered a separate entity altogether unto itself. So you cannot be involved in this in terms of personal liability in any way. So the lender that's going to give you a non-recourse loan is going to have some specific things in place before they do that. Because otherwise, why would they give you a loan that you're never going to be responsible for? Well, the answer is going to be because you have to sweeten the deal a little bit better. And this is about what it's going to look like. A normal investment property transaction involving financing usually requires 20% down. That's the normal deal. If you have an extremely high FICO and other compensating factors, possibly can get that down to 15% down. So your loan amount is 85%. In a non-recourse self-directed IRA, LLC formation that you have hypothetically set up now, you're allowed, usually it's about 50-50. So you're allowed, in other words, if you have a $75,000 in your account, like we mentioned earlier, you can acquire about $150,000 worth of real estate using the leverage. Your loan itself is going to be a non-recourse debt, like we said. It's going to be about a 60-40 loan. They're going to give you about 60%. You're going to put up about 40%. And then that extra 10% going to be for reserves. So that's going to be remaining in your bank account, in other words. So I'll play all this out in an example right now so you can see how all this flows and how all this can be set up to your advantage. Okay, let's look at a loan here, example. And this is just an example. You're part of the country. I get it. Maybe totally different. We can talk about it, what the realities are in your county, in your state. But let's just look at this example. So I'm assuming here you've got $75,000 in your self-directed IRA account. It's in an LLC, and you established a bank account. Okay, that's our foundation blocks of starting, to buy real estate in your account. So you've got $75,000. We're going to look at a purchase price of $170,000. Typically, the banks that do allow for this non-recourse debt will give you a 60% loan to 40% down. So 60% of a $170,000 purchase is $102,000. So out of your bank account, which has $75,000 in it, we're taking $68,000 out to pay for that down payment. You're going to have $7,000 left over as reserves. That should be, the bank should be roughly comfortable with that. Might be able to get away with that. So now let's assume that from that purchase of that home, you're going to get rental. The market rental on that is $1,525. $1,525. What does that note payment look like based on today's rates on a 30-year note? This is not based on your FICOs, by the way. This is based on a non-recourse debt with a 60% LTV factor thrown in. You're looking at about $773. Again, this is just an estimate. What does that go against? And you add that to monthly expenses. What are the monthly expenses? Well, you've got a vacancy factor. We've got maintenance. We've got property taxes. Of course, we've got property insurance. And we've got third-party management if necessary. So you ball all those together, and your monthly expenses total about $1,210. Okay. Now, here's the big key. The lender's only going to be looking at the property itself because, again, they're non-recourse. They cannot come back to you at all. They need the property to cash flow and cash flow pretty good. And that's why the LTV is going to be kind of low and stringent. And that's also why they have what they call a debt-to-service ratio. That debt-to-service ratio coverage ratio is going to have to be 1.25 or higher. What does that mean? That means we're going to look at the rent of $1,525, and we're going to have that divided by all the monthly expenses, in this case, $1,210. That ratio, 1,525 divided by 1,210 equals 1.253. So in this example, we are just above the 1.25% ratio coverage, the debt service coverage ratio that's required for all these types of loans. I ran through that pretty fast, but what we're saying at the bottom line is the bank is going to give you a non-recourse loan. Why are they going to do this? Because the coverage ratio, the cash flow that flows off of this property must exceed 1.25 times the amount of all the expenses that are associated with the property. And in this example, we barely squeezed by at 1.253. I probably fudged the numbers in an image just so I could show you an example that works, but this is kind of how it's going to play out typically. Whatever amount that you have in your account, be it $100,000, be it $200,000, be it $1 million, just know you're probably able to acquire about 2 times that amount given the loan amount they're going to give you and given the debt coverage that they're going to require. So hopefully all this makes sense to you. And this is how you acquire real estate out of your self-directed account. If you have any questions, call me, please. And text me at 210-317-6514 on the Mortgage Patriot. On your side, as always, Kevin Fagan, and make it a great one.